that raising rates, and whether it's through a series of 50 basis points or maybe 75 does at some point come back on the table. If you're trying to increase supply through investment, you're cutting off your nose to spite your face. You want capital deployed to ease all the supply constraints, and it's going to be more expensive to do that every time you raise rates. It's almost a catch-22 and a very difficult and blunt tool that the Fed has to just try to destroy demand. It's a real problem. I don't know. You sure you want to keep doing this?
Well, we have our job to do. We have to bring inflation back down, and I'm confident we will do that. But remember, the cost of capital for most large firms is still very, very low.
Right.
They can still go fund themselves at very attractive rates. So I think we're a long way away from the cost of capital being the barrier, for example, to firms investing in the energy sector. I do think it's more lack of confidence on where energy prices are going to be over the medium term to see what kind of return they get on their investment, and also the regulatory environment that you spoke about.
And Neil, the Fed has a dual mandate, and that's to focus on inflation, but to also focus on unemployment, the jobs market. In the past, we've talked about how the Fed probably has even more mandates than that, worrying about a series of other things, from the economy overall to what might happen with the stock market. Is it fair to assume, because at this point you sound like you are pretty laser focused on the inflation piece of it, understandably so, inflation is destroying things right now. Is it fair to assume that you're not paying that much attention as a body to what happens to the stock market at this point? It's going to be focused on inflation, and what happens to the market happens?
Absolutely. I'll be honest with you. I never focus on the stock market as a goal. We pay attention to asset prices as it comes back around into psychology and spending behavior. But ultimately, it is our dual mandate that drives us. For 5 years, up until the pandemic, I was probably the most dovish member of the Federal Open Market Committee. And I took that view because we were undershooting on inflation, and I still saw there was slack in the labor market. So if you're undershooting on both sides of your mandate, that means the monetary policy is too tight. Now we have a very strong labor market, and we want to keep it strong, but inflation is much, much too high, and we have to bring inflation back down. And ideally, if we have monetary policy dialed in right, those two things will be in tension. We'll be at 2% inflation, and we'll be at a very healthy labor market, and we'll have confidence that we've got it right. But right now, it's just imbalanced, and we need to bring it back into balance.
You just said you don't focus so much on the stock market unto itself, but you do focus on the psychological impact of the price of assets. And effectively, what I imagine you're saying is the wealth effect, or the lack of a wealth effect. Given where you've seen assets move over the last month, how do you think that psychology has changed? Do you think that, and also given some of the other numbers you were just talking about in terms of how much household wealth families have, how much more does that have to come down to change the psychology?
Well, it's a good question. When I think about this regime that we might be in a higher pressure equilibrium, the wealth effect is part of that. So stock prices were very high relative to pre-pandemic. Home prices very high relative to pre-pandemic. And then even the lower income households that don't own stocks or don't own a home, many of much stronger, healthy balance sheets than they had before the pandemic. My theory is that all of that is leading people to feel more confident and to spend more, and maybe that's what's pushing us into this higher consumption, higher spending, higher inflation regime. So yes, the stock market has come down. Home prices are still very high. The latest data is they've still been quite robust, even though mortgage rates have climbed quite a bit just over the course of this year. And again, household balance sheets continue to be very strong. And so, we just need to keep paying attention to the data. Some of the most recent inflation data on some measures is a little softer than we had thought might come in. So maybe there's some evidence.
Good morning, T-Speaker 222 XRP Future Millionaire with the side bet on XLM and Future Digibyte OG So guys, we're seeing that retest we talked about yesterday. You have to have retest, guys. We were so oversold. If you guys watch my live streams or my updates yesterday, you would know we talked about this retest, and it's a common one right now. We had such a big drop. We created this W reversal. I was surprised yesterday, if you remember, when it hadn't come up to 52 cents yet, or 53, and made this push up, because we had this drop point here, and it's not uncommon, because I said if we didn't close the daily underneath this descending support line and use it as a resistance, and we're in this channel, which meant we could come all the way back up to 59 cents. Very clear about it yesterday, because if we're not below the channel, we're trading within the channel. So right now we're trading within this falling channel, and the moment we break it, that's when it can start capitulation. But right now, we have the ability, even though we have a bearish engulfing candle, the thing, like I said yesterday, we never broke the low yet. So as of right now, we bounced off of 47,289, essentially a double bottom, slightly inclined. And now we've worked our way back up. But I said also yesterday, until you break 55,673 and put any kind of upward pressure on, this is just a retest of drop points, and a likely fall over, it'll likely fold. Right now, we have engulfing candles in the 30-minute. We're trying to start some kind of a bullish engulfing, or a bullish divergence in the 30. So remember, though, even if you see this in the 30, in the weekly, we already started a bearish cross. This is confirmed. So this is going to be a retest of some of these drop points, and likely, drag some more people along for the ride. Me personally, I didn't buy any of this dip. People are, well, Tom, why didn't you buy it? Well, I'm already trading in my assets on Lobster that are doing far better than this. And I'm not going to trade not knowing if I'm going to make 7, 10, 12%, 15. Some of them are up 15 to 20%, but they had substantial drops. So even the ones that are up, had you have bought them before the drop, they're not up. To start the week, we're at $1.18 for Matic. To start yesterday, we were at $1.02. Now we got a little upward pressure here for Matic, but we're still coming to these drop points, resistance now that we're support. And I only show you Matic because XRP is very similar. We had this drop point from yesterday. We started at 58, 59 cents, and now all of a sudden we're working our way back up, and people are getting excited because we're up 7.5%, not even acknowledging that we dropped better than 20% from where we were at. And now we're just back testing. This is still a bearish engulfing candle. Until we get some upward pressure and break this falling channel, our best hope is to come up to 58 and then just come back down next time to 46 and keep playing this game, and it'll continue to come down as we go. Right now we're having a retest. I would stay in the 30-minute time frame, see if we can start a bullish divergence in the short term, because I would not be surprised if we came back up and retested some of these drop points. We were very oversold yesterday, as we know. We've come way up, though, and these pushes are starting to get towards, I think we're starting to cap out here. If you look at the volume on the push up, it's been atrocious. This has been nothing more than a dead cat's bounce, in my opinion. It can continue to go up a few more percent. We would be capped, like I said, at 58 cents. I said this yesterday, too, on the channel. And that could have been a better than 25% return rally. But that's why selling it on a dip like this, it's very dangerous, because you have the retest. So like I've told everybody who asked if they should sell at 50, 52, that's a tough decision, because we always have these retests. I told everybody, if you were going to sell, wait for it to come back up to 52 cents and sell it around there. That's what I told everybody. Some people decided to sell it right at 50 because they panicked. Watch it go to 47, and now it's back up to 53. This is what I was talking about. You always have retests. You have to. So the top of the drop point retest would be about 56.4. If it overachieved, it would be about 58 cents. Nothing more, nothing less. Make sure to hit that motherfucking like button. I'll be back shortly.